This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today.
Mat Sorenson, welcome to the show. Thank you for being here today.
My pleasure. Excited.
Well, why don't we get going? I mean, you have quite a broad array of background and experience. Yeah. So why don't you give us a little background where you started, and then we can move through according to how we can apply those things to our listeners.
Awesome. So, I'm a tax lawyer by trade. That was my profession. I was a prosecutor. I went into corporate America as a business and tax lawyer, and then have my law firm, KQS Lawyers, with my partner, Mark Kohler, and we got 60 plus legal team helping clients across the country from a business and tax standpoint. But what I did as a lawyer is I got focused in on how people can use retirement accounts, which there's $35 trillion in retirement accounts, but how can people use that money to invest in real estate or private companies, small businesses? And we had clients in our law firm that just wanted to do it. And there was not a lot of good information out there. Wasn't on the bar exam, didn't learn it in law school. There was no good books on it. So I just hyper focused in that niche area as a lawyer. I love the strategy on how IRAs, 401ks, Roth IRAs can buy real estate and invest in funds and all these other things. Then I wrote the #1 book in the field on it, which is my book, The Self-Directed IRA Handbook, which government agencies use my book, by the way. The National Association in my industry uses the book as part of a certification training program. So I became the expert in like one little thing, how retirement account can buy real estate in private companies.
I love this. Okay, so when you were little, you're like, I want to grow up and be an attorney. And then you grew up and you said, I want to be a tax attorney. And then you stumbled into this. Like, back up just a little bit more.
Yeah.
Love how you found this niche and you're just owning it. This is great. But back up just a little bit, and then this is kind of like your main gig now.
Yeah, it's the main thing. I'm keeping the main thing too. So I just was super attracted to it as a strategy. One, because I knew it was underserved. I was like, people don't know about this. Even yesterday, I was meeting with a bunch of business owners. These are people that run large organizations. And like one of them out of 10 had heard about this. And so I'm like, there's a big market of people. First of all, there is $35 trillion in this that don't even know you can do this. And so many people are so frustrated because they have an IRA or 401k, but it's invested in something they're not passionate about, they don't care about, and they don't know much about.
Right.
And so we're like so disconnected from that money, but it's such a big part of our financial security and what people want to retire on in later years. So I was like, this could be really cool. So I just dug into it and learned everything I could about it. The nice thing was I had clients paying me by the hour to figure it out. So
nice.
Yeah. So I got paid for that, which was great. But I like it myself. Like, this is what I do with my retirement account. Like, my IRAs own rental properties. Right now, my retirement account does private money lending exclusively. I'm lending to other real estate investors to put it on deals. They need capital to do deals. I need deals and I want to get my money out, right? And invest it. And so it's like a win. So I just love the topic, but it's actually funny because my main business now is Directed IRA. That's our IRA company where we handle self-directed IRA accounts, directedira.com. You can find us, but we have 1.5 billion in assets in the last 4 years. We're setting up 30, 40 accounts a day for people that want to go invest in real estate or a private company. And so, but that's what I'm doing every day now, transitioning from being a lawyer, advising clients. But honestly, I went to law school wanting to own a business, not just a law practice, but thinking there was some other thing I could find out from the expertise and connections of being a lawyer. That actually was my plan. It seemed, and that's what happened. And so I love the law, don't get me wrong, and I love being a lawyer, but as a lawyer, you trade time for money. You know what I mean? You bill and then you get paid. And then if you want to make more money, you got to go trade more of your time and bill to make more money. So
this is the best of both worlds. What's your favorite lawyer joke?
My favorite lawyer joke. That's a good one. I don't know. There's always like the ones like, what do you see? I don't know. I got a good lawyer joke off the top, actually.
If you're the lawyer, you can say the joke, but if you're not, you couldn't be saying that.
I know.
Okay, so let's talk
I don't want to get kicked out of the club. be
Yeah.
disbarred
Okay.
or
We
something.
can't
So
see
I'm
your
not going to give
partner.
one.
Your role is secure. Um, okay, so what do you do for investors? Do you then host a platform? Let's kind of back it out. Let's say
Yeah.
I'm somebody who has a 401k and it's not self-directed, which is
Yeah.
untrue. I do have a self-directed 401k and it is diversified in real estate
Nice.
investment.
All right.
But like, let's kind of break it right down for
Yeah.
the listeners, like you said, never heard of this before.
Yeah. So what we do is, one, we just want to educate people on what they can invest in. I'm not telling people to invest in real estate. Invest in whatever you want. Invest in what you know and what you're good at and what you're passionate about. Well, what I'm out there telling people and educating is, you don't just have to buy an ETF or a mutual fund. And so we spent a lot of time, like tomorrow, I'm going to be speaking in Dallas to a group of real estate investors. I'm going all over the place. I'm speaking in Seattle to a group of private equity investors that are basically investing in small, medium-sized businesses they're trying to grow, right? And so I don't care what you're interested in, but I'm just telling you, most people are not interested in an ETF or mutual fund. And sure, you might want to have some of your money invested in that, but we've just been brainwashed that's the only option for your IRA or 401k. And of that $35 trillion that's out there, I mean, this is the most investable piece of money, period. There's no more money anywhere to invest in anything than US retirement accounts. And it's a lot of money, and we all have a little sliver of that. And someone listening, you think you have an IRA or 401k, and do you even know what it's invested in? Your friends and family do. Your spouse might. And just know that you have options. And so that's what we're doing. And at Directed IRA, we handle the accounts. So if you want to use an IRA or an old employer 401k, you need to have a custodian for the IRA. And you can self-direct a 401k too. I don't know if you have a solo 401k or what. If you're self-employed, there's lots of options there. I wrote a whole freaking book on this stuff. So, and I have a 2-day conference on it. So I can talk forever about it. But so you have to have a custodian, just kind of like you have to have Fidelity for your IRA or TD Ameritrade or whoever you're using when you're buying stocks or mutual funds. If you're buying real estate, it's the same thing. You need to have a custodian of the IRA. And that's what Directed IRA does. So we're like a Fidelity or a TD Ameritrade. We provide the account, we do all the tax reporting, and we qualify it from a tax standpoint so that you don't pay taxes, right? Because that's your IRA or 401k is the same thing. Like this, I just want to make sure everybody understands the concept here. Let's say I buy Facebook stock, 100,000 of it, and it goes up to 150 grand, and I sell that 150,000 now, that 150 grand of stock, the cash from it goes back in my retirement account, right? I don't pay any taxes, that account at Fidelity. It's not hitting my 1040. It's all building up in my retirement account. Now I got 150,000 to invest. Well, it's the same thing for real estate, right? If I bought a property for 100 grand, it goes up to 150 and I sell it for 150, that whole 150 goes back into my retirement account. I don't need to do a 1031 exchange and meet some deadlines, right? It's like the whole 150 goes back to my retirement account. And now I can invest it in the next deal. It's not going on my 1040. It's not going on my personal tax return. It's growing to later come out in retirement. So that perk of not paying tax when you're making money, whether it's rental income or gain on a property or you're investing in a fund, whatever it may be, that same tax benefit you get on a stock or a mutual fund is the same for real estate. It's all tax deferred for your traditional accounts or tax-free in retirement accounts. It's not hitting your 1040.
Beautiful. Okay. So let's say I'm somebody and I want to get rolling. I go to your platform. Is there an amount that is too small to do this? Like, is it worth it for any amount? Let's say somebody doesn't have let's say somebody does have a lot. Would you advise them one way or another based on what they have?
I would say the average investor needs 50 grand.
Okay.
If you're an average investor, and I mean like you're not a professional in the space, you're not in the real estate space on a daily basis, you're like me, I'm an average investor. Okay. I didn't buy my first property in my retirement account until I had 40 grand. I just bought a single family rental. Is in Indianapolis. I sold it for 185 5 years later, had a 250% return on it. Way better than the S&P 500. I'm an average investor. Okay. But right now I just private lend my money and just think of 50 grand. I can lend that at 12% and 2 points right now. It's good hard money lending rates. I get it secured on property. It's way better than I'm going to get in the stock market. At that rate, that's a 14% annual rate when I include my
private lending. I didn't know this. This is great.
Yeah. Heck yeah. Yeah. I love doing this. This is what I'm doing with most of my money now. And so, but now if you're a really good investor and a pro, which we have lots of them, they can come in with a $6,500 1-year contribution. They don't have any retirement account dollars to start with. They just throw a 1-year Roth IRA contribution in of $6,500, and they can go wholesale a property or do an option deal or get in on some deal that they can turn that into 50 grand or 100 grand. And so they have enough deal flow and opportunities where they can turn that into a large gain. So I'll give you an example. And this was a client that had 10 grand in a Roth IRA. And this was the moment I decided, working with this client, that this is what I want to do forever. Okay.
Let's hear it.
He only had 10 grand. Now, this was a pro. Okay. He's a real estate investor and developer. There's a piece of land that was up against the highway that was agricultural land. Now, my client knew that the county and state were going to put an exit off that highway there where this land was, and that this was going to go from just agricultural property to like highway commercial. And so he went to the landowner and he said, hey, I'll give you 450 grand for this property, but I just want an option to purchase. I want a 5-year window to acquire this property for 450 grand. Now, at the time, the property was worth 300, 350 maybe. And so the owner of the land for the agriculture is like, what do I care? If you're willing to pay 100 grand more than it's worth, I'll go buy land down the street. This is agricultural land. I don't care. And so my client bought an option with his Roth IRA. So his Roth IRA gave the guy $10,000 as a fee, as an option fee, to have the right to acquire the property for $450,000 within 5 years. Okay. Now, this is a client that does this all the time, right? He's always optioning out properties and stuff personally. But when he sells those things, he pays tax and he's in high tax rates, right? And so he wanted to do this in a Roth IRA. Okay, so now fast forward 3 years later, the highway exit comes in, and now there's people wanting to put in a gas station, right? They want to put in a convenience store. They want to put in a Subway.
One question, just to clarify for listeners, what exactly does an option do from the standpoint of an investor?
So from the investor, you have the right, but not the requirement to buy the property at the agreed upon price. So they agreed that my client would buy the property for 450 grand, and the seller had to sell. And so my client had that 5-year window to buy that property for
If they
450.
have to sell, they can't say, I'm going to hold on to the property.
They have to sell. Okay. And now it depends on how you wrote it up, but that's generally what it is.
Okay.
Now, if you're an owner of property, you're not going to just give options all the time. But my client gave him 10 grand. Okay. He said, here's $10,000. So I'm serious. I'm securing this right. And it was a price over what the value of the property was at the time. So the seller was like, sure, dude, whatever you want to, I'll take your money. But his Roth IRA did. This wasn't him personally doing this or his personal LLC or corporation. This was his Roth IRA. Now, why did he use a Roth IRA?
Roth IRA LLC or whatever.
Yeah.
Uh-huh.
It was actually just done out of his Roth IRA. He uses an LLC now. But you could do either way, and we can talk about that. But now, why would someone use a Roth IRA, though? Because it's no tax. Okay, this client's in his 50s. And so what happens later is this property ends up being worth $1.5 million. Okay, that's the value of the property. So he sells the option to another developer, someone he knows. He's in the business, right? So he's doing this all the time. Sells to someone he knows for over $1 million gain. He doesn't buy the property. His Roth only had $10,000.
Oh my word.
He sells the option for over $1 million because it's worth 1.5. And he has $1 million gain go into his Roth IRA. Okay. So now this is the moment I was like, all right, this is what I need to do. This is pretty cool. This client paid 0 tax on this. And now he's got a 10 million plus account now, but now he had $1 million in his Roth IRA and no tax. And now so a lot of people need, like me, I'm a base hitter. Okay. There's home run hitters out there though. We've got lots of them, like guys like this. They hit home runs. They turn $10,000 into $1 million in a deal. That's not me. Okay. I'm just a base hitter getting my 12% interest or my cash flow on a rental and some appreciation when I sell. But that's way better than an ETF or mutual fund for me. So you could be a home run hitter and you could be a pro and you can just have 6,000, 10,000 bucks in an account. If you're just kind of a novice at real estate, or you got a day job or a business and you kind of invest somewhat on the side, you might need about 50 grand. But let me go back to that client, because I want to say one other thing about that guy. That guy, when he ended up finishing this, okay.
Yep.
I had a call with him. He's like tidying it up, making sure he did everything right. And we finished the call, and I was like waiting for high fives, right? Nope. He went on a little rant, and he was pissed off. Okay.
Why?
Because nobody told him he could do this before.
Oh,
And
right.
he's like, I have the big CPA firm, the big law firm, a financial advisor. All these people knew I made money in real estate and hate paying taxes. Not one of those dummies told me, and he was dropping some F-bombs here. I'll save everybody from that. Yeah. Not one of them told me I could do this. He's like, I had to go self-discover it. And then he found me to teach him how to do it. But he was super pissed off because he's like, I've been buying mutual funds, and he's like, I don't know what the heck I'm doing there. And so that brings a really important principle that we've tried to do, that we've instilled in our company at Directed IRA, that's even kind of guided my own personal investing philosophy, is invest in what you know. And people have these retirement accounts sitting out there, and they're investing in stuff they know nothing about. And go look at the history of it. Has it done well? And if real estate, why aren't you investing your retirement account in that? And so, I don't know, that was kind of a wake up moment for me. And I was like, this is what I need to do. There's a lot more people out there like this guy, not necessarily home run hitters, just some base hitters too, that really need to know they can use this strategy and invest in what they know. Real estate has been one of the tried and true methods to grow and build wealth in our country. And we just have not thought about it for retirement accounts.
So that retirement account now has millions in it. I mean,
yeah, he's got a 10 million plus account. I mean, my largest client is a real estate guy too. He has a $300 million Roth IRA.
Dang. Okay.
Yeah.
My mind just got a little bit blown because I had Roth IRAs in a little box over here. I didn't realize how rapidly you could scale it. So I have a question. Help me and our listeners understand the difference, even from a tax purposes reason, why a Roth IRA is different from a self-directed 401k, what you can and can't do with one versus the, or can you do the same?
Okay. So in the world of retirement accounts, we have 401ks and IRAs and Roth accounts and traditional accounts. So hang with me here, because this is a little complicated.
Paint the picture. We're with you.
All right. Okay. 401ks are like when you have a job. You work at a big company or you're self-employed. You can have your own 401k called a solo 401k. Maybe your own business that you own with employees, you can have a 401k. In a 401k plan, you can have it be self-directed, where you could invest in real estate or other assets like this. The problem is most people that have a 401k plan at their day job, you work for a Fortune 500 company or whatever, like they're going to let you buy mutual funds and that's it. They don't let you buy real estate or self-direct it. So in the 401k space, that's all employer-based plans. Now, but you can have Roth or traditional. I'm going to come to Roth and traditional in a second. IRAs are individual accounts. Anyone can have an IRA. You just have to be an individual. Most IRAs are funded from an old employer 401k. I worked at a company for 10, 20 years and I saved a bunch of money in it. My company did matching. And now I've left, and that 401k that's at Vanguard, I've rolled over to an IRA at Charles Schwab or at my XYZ bank or credit. Now I'm buying stocks or whatever I'm doing. That's a huge piece of the industry. That is the largest piece of where retirement account dollars are right now. They're in IRAs, but they started in an old employer 401k. There's almost $15 trillion of that 35 trillion I mentioned. 15 is that alone. Okay. Now, when you get to IRAs, you have traditional and Roth. Traditional is what we call tax deferred, or I like to call it tax laden. See, when you put money in your traditional 401k at work, or you put money in a traditional IRA, you get a tax deduction. If I put $5,000 in my 401k at work, it's a traditional account, or my IRA, that's a traditional IRA. I put $5,000 in, I got a $5,000 tax deduction that year. It saved me tax. It lowered my taxable income. But there's a catch on a traditional account.
Mm-hmm.
It's tax deferred. It's cool that I don't pay taxes. I'm investing. I'm making money. It's not hitting my 1040. I'm just growing the account. I get to reinvest every dollar. But when I start pulling money out at 59 and a half, which is the age when you can pull money out, you start paying taxes.
And there's no way to avoid that.
There's no way to avoid that in a traditional account.
Right.
Okay. Now, a Roth account is what we call taxed never. Okay. So we've got traditional, think of tax later. It's going to get taxed on the way out at retirement. Now, a lot of people are like, well, but I'll be in a lower tax bracket. I won't be working, or I won't have my business anymore. So I'll be in a lower tax bracket. So it won't be that brutal. And that can be true. There's a ton of traditional accounts out there. The Roth IRA, though, is tax never. Now, in a Roth account, when you put money in, and this could be a Roth 401k, or this could be a Roth IRA. When I put money in my Roth IRA or Roth 401k, let's say I drop $5,000 in, I don't get a tax deduction. The government's like, good for you, but we're not helping you save taxes today. But we're going to let that investment grow, and you don't pay taxes. You're building it. And when you pull it in retirement and you start taking money out, no tax on the way out. So our principle and why we love Roth accounts in particular, whether it's a Roth IRA or a Roth 401k, the reason we like it is we'd rather pay a little bit of tax now as you're putting money in on the seed, so to speak,
100%.
than paying tax on the harvest later. And
Yes.
it's grown and it's big.
It's so practical. So are both, can you get both in the self-directed vehicle?
You can self-direct both. We have thousands of traditional IRAs that are self-directed. And actually out there in general, there's more traditional IRAs than Roth IRAs because people like the tax deduction now, and they've been around longer. Roth IRAs are a little newer. They've been around now for almost 20 years, but traditional IRAs are definitely, they've been around for 40 years. So they're more popular.
Like, if you want to get in and start hitting home runs, let's say, the Roth IRA is the vehicle.
Exactly. Yeah.
Yes.
Even if you're someone in your 40s or 50s, like you're not going to draw on this thing for 10, 20 years. And even if you're a base hitter, the Roth IRA is where to go. Definitely the home run hitters. That's a given, right? That's an easy one. Like my client with the 300 million Roth IRA, he doesn't want to pay tax pulling that stuff out, right? So, and he knew he was smart. He's successful. He's going to do a Roth IRA.
So what does the conversion process look like for a self-directed Roth IRA?
Okay. Well, there is something specifically called a Roth conversion, which is actually, when you say that word, so that might not have been your question, but I want to say what a Roth conversion is. If you don't like.
No, that's okay.
Maybe it was. Okay. Is that if someone has a traditional IRA, they can turn it into a Roth IRA. And so if you're like, oh, I've got 100,000 traditional IRA, but I'd rather have a Roth IRA. Well, you convert it from traditional to Roth, and the IRS is like, cool, we're going to let you do that. But there's a catch. That 100,000 account is now taxable in that year. So let's say you had an account with us, a traditional IRA with us, and you're like, all right, Matt, I want it to be a Roth. I get it. I want tax-free on the way out. I don't want to pay taxes in retirement. Convert it. We're going to send you a 1099 for 100 grand. And that 1099 is going to go on your 2023 tax return, 100,000 of income, which if you're in a 30% tax bracket Fed, 5% state, that's 35,000 in tax you're going to pay. But just think about this, if you turn that 100,000 into $1 million within 10, 20 years, whatever your horizon is, 30 in investing, you've paid 35,000 in taxes instead of 350 grand, assuming your tax rate was 30% and 5% in retirement. So we're kind of like paying the price now to get to that tax-free vehicle later. Yeah. But you can convert to Roth, and we're doing it every day. Someone's converting to Roth here. We have more Roth accounts than anything. So,
wow, I'm just wrapping my mind around all of this. That amazing. I guess I only knew a very small portion of the power of these vehicles, but that story about the options, I mean.
Yeah, I mean, and all, like, I'll just give my example, because I think some people are like me, like I hear that example, that gets me excited, but I don't have that deal. So like, to me, that it's a cool thing. And it was a guideline for me. And like, oh my gosh, there's people that need this strategy that could do like amazing things. But even you just think of like the private money lending. I know it's boring. It's not as exciting as going out and doing $1 million option. But if you think of like lending your money at 12% interest and 2 points, that's 14% annual return. I am doubling my money every 3.5 years at that rate.
Nothing to sneeze at.
Okay. That the compounding of that's pretty great. And I remember the reason I got into that is I had a client that had about 600,000 or 700,000. This is 10, 15 years ago. He had about 600,000 or 700,000, worked in corporate America, left, rolled the whole thing in and started self-directing. Only thing he did was private money lending. And his account's 10 million plus now because he's been doing it consistently for that long. He's not hitting home runs, guys. He's hitting maybe doubles. But he's just consistent and he's getting a better return than he can otherwise get in the market. He's investing in what he's passionate about and he knows and he spends his time in it. So,
Matt, you also have a lot of experience raising private capital. This is very applicable to a lot of our listeners. So let's pivot and spend some time there. What can you tell us?
Well, thanks, Deana, for having me back. I appreciate it. I think, and I know we talked about self-directed IRAs before and from like the investor standpoint, but if you are someone raising capital, I just want to make sure everybody understands this. This is the easiest long-term spot of money where you can go raise capital, IRAs and 401ks. We talked last time, there's $35 trillion. I don't know if you heard the last episode, anybody, but there's $35 trillion in IRAs and 401ks. That's more money anywhere to invest in anything. And so if you're someone who raises capital to do deals, I don't care if you're getting private money loans, you're doing little partnership LLCs where you have some investors and you're the deal person, you got a fund. The money where it's most likely someone's going to have 100 grand to give you long-term, it is more likely they're going to have it in an IRA or 401k than a savings or investment account. IRAs and 401ks is where we have been told and where we have stocked money away as Americans to invest.
It's true. It's so true. I'm just kind of, after I got into this real estate syndication space, really realizing the power of this money that just seems like it goes into a closet in the guest room. That's what 401ks are assumed as. So we're going to take people down to the guest room. We're going to open up the closet.
I like it.
And so if you're a capital raiser, let's talk about your strategy and how you can convey and communicate this effectively.
And I think the first thing is for a capital raiser, know it yourself, understand the strategy. And if you don't want to have an IRA or 401k yourself, you're like, I don't care about that, Matt. I want to make money today. Cool. Don't have one. You don't need one. But I'm just telling you, the people you're already talking to, the people who may have already invested with you, have money in an IRA or 401k that they would love to invest in real estate or a private company. They are like bored of the mutual fund or ETF. They don't even know the name of it. Okay. I'll just give an example. We had a real estate fund that worked with us down in Texas. They had about 1,000 people that invested with them over about 10 to 15 year window. And they're pretty successful. They've been around for a while. And we did 2 webinars with them. They've kind of broached the topic a couple times. They'd worked with another company, but they never like connected it to their investor base. I'm serious. We did 2 webinars and opened up 300 plus accounts, and they had 30 million invested within 90 days.
Boom. That's significant. I need to sign you up for some capital. We'll take care of that after the show.
I mean, that's like next week. I want to Seattle, do it for another group. It's just like the strategy. You just need to know how to ask the question. And what they needed is they're like, we need to just roll this out to people that already trust us, but we've never really asked the question effectively of, do you have money in an IRA or 401k? Can you access that to invest it into our deal? And so it's just a super powerful question. Even at this desk right here, I did a webinar. We do directed IRA webinars. I'm here in my studio for anybody on video at least. And I had one of the guys that does a lot of deals. He's here in the Phoenix area where I'm at. He's flipped 250 houses here. Okay. He just flipped single family houses but he funds them with private money. He said 60% of my investors use IRAs and 401ks. And the only reason why is because he knows the strategy. right? But
Right.
here's the thing that he told me, and I've heard from other people, is why he loves doing IRAs and 401k. He'd rather have someone's IRA or 401k money than their personal funds because it's long-term money. They
Yeah.
don't want it back. When that deal is done, they're like, when's your next one? I'm 45. I can't use this money for 15 years. I need it to go in another deal. Rather, if it's their personal money, they're like, well, I've got this new car I want to buy. I got this second home I want to buy. I got whatever, my kid going to college now. I need that money back. And so it's long-term money too, which is awesome from someone raising capital because they want it to stay invested. And when that deal's done, they're like, can you just throw it in the next one?
Yeah, that's really true. It sometimes feels, and I'll say this personally from my own self-directed
Yeah.
money, it kind of feels like monopoly money, just a little bit, because I know, like you said, I know I'm not going
Yeah.
to see it. If I make a mistake, well, I've got years because I'm
Yeah.
29, right? Forever.
Uh,
And then I agree with that. There's some psychology there.
yeah. And I mean, and it's built into just like what retirement accounts are for. It's also like you can't tap it until you're 59 and a half, right? So you've already thought of that psychologically, whatever it may be, that this is, I need to just keep it invested. I'm not looking for that return to come back on whatever deal you have so I can spend it on something. In
Hmm.
fact, when it comes back, I'm like, it's more work for me now because now I got to think of what I'm doing with it next.
Motivating to roll it over. Yeah.
Yeah. So I think, so let me just summarize a couple of those points. One, it's where all the money's at. There's 35 trillion. Two, it's most likely the people you're already talking to have this money and you've just never had the conversation. And just ask, do you have money in an IRA or 401k? What are you making on it? It's been in the stock market. It's been a roller coaster lately, right? And then also realize that money is generally going to be long-term. They're not going to be asked. They're not that investor. It's like, how's this thing going? When am I going to get my money back? Are you going to sell that property? Is this still happening? You know what I mean? You know
I
what
know
I
what
mean?
you mean.
Yeah,
I mean, investor relations.
exactly. The IRA and 401k ones, they're like, just keep it invested. I don't want to hear about it.
So good. Okay, so you just really broke it down very simply. Do you have any money? I mean, I'm curious, do people know what it's making if you ask them that question? Do they have a
Yeah,
clue?
no, they don't. And that's perfect because they don't know, but they've been kind of through like most people, at least in the stock market, which is typically where you're invested, whether it's a mutual fund or ETF, they've just seen their account go like this.
Mhm.
Over time, it goes up, but we're down from where we were a couple of years ago still. The market's been coming back slowly, but it's down from where it was a couple of years, whereas real estate hasn't really. And so what's interesting is it kind of, it's almost like I was teaching a group of commercial real estate agents this topic, and I had a couple of them come after me and talk about this. And they're like, "Man, I'm just going to look so smart with my clients now. Like I know this strategy, and I can sell them more real estate using this strategy." And I think it from someone raising capital too, it's like it makes you seem like what the heck you're doing. Like how IRAs or 401ks can invest in real estate. Not only for that, there's this huge opportunity out there. So I think it ups your game in terms of like your appearance and that you know what you're doing. You can use retirement account dollars, but you don't have to be an expert at it. Don't
Mhm.
feel like you need to read my whole book. Like I wrote a whole book on this. It's like 300 pages. It's got over 100 plus legal citations. It's a great book. I want you to read it, but you don't have to. You just need to know the strategy enough to know, oh, that's a 401k at an employer you don't work at. Oh, you have an IRA at TD Ameritrade? That can move over to a self-directed IRA. Here's a company, Directed IRA. That's our company, but whoever it is. Here's a company that'll help you roll it over to invest into real estate or to invest in my fund. You can be an LP or invest whatever it is in my deal. And so, but that's what my team does, right? They'll take the call. They'll figure out what type of account that person had. They'll transfer over the money for them, right? They don't have to do this. You don't have to be an expert and to handle this. Like we do it for you.
You're the custodian.
Yeah, we're the custodian that holds that account. So like if they got money at Fidelity and they call it Fidelity, like, hey, I want to invest in the XYZ LLC fund that's buying a value add multifamily property in Tucson, Arizona, right? Fidelity is going to be like, you can't do that. And that's not because IRAs can't invest in an LLC fund like that. That's because IRAs at Fidelity can't. All right. So they need to move the account from Fidelity to a company that lets them do it. And there's 30 companies that do what we do. I mean, we're not the only one out there. We're just the best. So they can move their account from Fidelity to Directed. There's no penalty, no tax. If it was a Roth IRA at Fidelity, it's a Roth IRA at Directed. If it was a SEP IRA at Fidelity, it's a SEP IRA at Directed. If it's a traditional IRA, if it's an older employer 401k traditional account, it's a traditional IRA at Directed. And so we just help facilitate that and an actual custodian that invests it wherever they want. So when they have an account with us as a self-directed custodian, we're like investing whatever's allowed by law. As long as it's allowed by law, we'll let you do it. And so, but real estate syndications or private funds are actually the most common investment here. We do a lot of them. So it's very popular, and our team's definitely equipped to help people sort through that process.
So what sets you apart as a custodian from the solo 401ks, the EQRPs of the world, the other custodians?
So what sets us apart is we know what the heck we're doing. So we're like, I would say we're the true experts in the field. Like my book really is the #1 book. Federal regulators, state regulators literally have used my book and buy it from me. The National Association in my space uses my book for certification training. And so we're like the place you can rely on. We're a licensed and regulated trust company. We're audited by RSM, which is a top 10 CPA firm. We have bank examiner audits as part of our licensure. Not all of our competitors do. Ones that are doing solo Ks and EQRPs have 0 licenses and credentials. Like just like you go set up an LLC and do this tomorrow. It's freaking scary. And so, but we know all the strategies too. And so whether you want to do an IRA, and by the way, an EQRP is just a solo 401k. It's just a marketing name. But solo 401ks are super popular. I love solo Ks. There's a whole chapter in my book on them. Like I frankly was one of the pioneers on the solo Ks as a lawyer on how to use these in real estate. But that's a limited strategy for certain people. The only people who can do a solo 401k are self-employed people with no employees. So I love the solo K. And what that is basically, it's like a 401k plan for someone who is solo. They're the solopreneur. And so Congress was like, well, if someone works at a big company, they get a 401k. But what about the self-employed person? They don't really have anything great. Then they created this and allowed you this solo 401k. But it only works if you're self-employed with no employees. Well, most investors, if you think someone raising capital, they work at Fortune 500 company, or they're in corporate America or in small business. They can't do a solo 401k, even if they own the business, right? I'm a business owner. I can't do a solo 401k because I have employees. I'd have to offer it to every employee I have and do all this crazy matching, which you'd never do. So basically, we are going to know what strategy works for the right person, what account type to set them up in. And that's the problem, because what happens in the industry and why we're different is, and it seems like we know what we're doing, but like, I really believe, and our team believes in making it easy, doing it right, but making it easy. Because in investing, complexity is the enemy of execution. And if you make it too complex, they're just not going to do it. They're going to be like, that's why they're in an ETF.
Right.
They click some buttons or they filled out a form 10 years ago and they have no idea. And they just haven't done anything else. Yeah, because it was easy. And so you got to make it easy to get through that. So our team is focused on it, but also on doing it right. And a lot of people, I have to say this, the biggest non-compliance in our space is people with solo Ks and EQRPs. I'm just telling you, we fix one of those every day because they're done wrong. They're people that don't have them right. And I've talked to very sophisticated people that should have known better, that have them. And I'm like, you actually don't qualify for this. And so we want to make sure it's done right, but also make it easy. And that's kind of an ethos within our company here at Directed IRA. But we also love it. Like, you just look at our 5-star reviews. People can look at what we do, and we just are passionate about it and helping clients. So
I love that. And it seems like you really are adding value to multiple parties. So if we have capital raisers who are listening to the show right now, you can add immediate value to them, equipping them, and then they can add immediate value to their investors, who then are going to add value to you and your business by continuing on with the great and excellent service that is legal, licensed, all of that stuff.
Because
So
I think when you're working with investors in particular, right? I mean, you need to come off well. You want to look like you know what you're doing, that you have good third parties. And I know this. I mean, the reason I set up Directed IRA is because I was a lawyer. I wrote the #1 book. I would get 5 emails a day of someone like, I read your book. I need to know, where should I set up my account? Who do you recommend? And I was sending to a bunch of companies that I liked, but like just didn't do a great job. They didn't make my job easy. I'm like, guys, I'm laying these people up for you. And they're coming back to me asking me all their questions about what form they should fill out on your website. I'm like, do your job. So, so we're very aware of that on our side, is like, we will be the experts on that. We'll take ownership of that to get the client set up, get the things, steps done that needs to get done, make it easy, but take ownership of it. And that's, I think, from a capital raisers, and that's what the feedback we've got. We have a whole business development team and everything that works with capital raisers to make it a streamlined process. So we know your fund, we know your subscription docs, we know the process that you want. You have a single point of contact, whatever you need. We kind of dialed that in. But in the end, our goal is we want to open an account and have it invested. The best outcome for us is the same thing for you: an opened and funded account that's invested.
And then when people come and they open their accounts and they're new to this and they're like, where do I invest? Like, how do you
Yeah.
advise your clients? Are you not allowed to advise them, or do you have a suite or a menu of options?
Yeah.
Or how do you educate them and stay legal?
So we can't give any advice, investment recommendations. So we will get into structure. If someone's like, I want to invest into this, how do I do it? Like, we can do that. But in terms of what to invest into, we don't give any advice and can't as part of our license. So we just don't. And that's, frankly, it's not our expertise either.
Mhm.
Like, I'm not the person that's like, here's the best deal, doing the best thing, and everybody needs to go over into this. That's not me. Like, I'm more of the technical expert, and our team is too. And like, oh, you want to do that? Oh, you want to invest in Mexico? Oh, you want to go invest in a private fund? Oh, you want to go buy crypto? You want to buy a Mexican soccer team? I had a client do that. You want to own a racehorse? I've had clients do that.
Here is Roth IRA.
Yes, yes. Like, we've had
Wow.
clients do, I mean, a lot of pre-IPO companies, but it's also like, you want to own the duplex down the street. You want to lend to your friend on your bowling team that flips properties. I don't know. Like, we know what you're going to need to get set up and what's going to take to pull it off. That's where our expertise is.
Yeah. The pre-IPO company reminds me of the options story that you gave in the previous episode.
Yeah.
If you're going to listen to that, you should go listen to that. It's an incredible
Yeah. Yeah.
tax advantage way to massively scale
Mhm.
wealth without tax. That's great. So let's say we have a capital raiser. What chapter would you direct them to in your book?
So I have a chapter on private companies and funds. That's the chapter. I think the other thing that's really important for someone raising private capital to know is the basic process for someone. And we kind of touched on this a little bit, but there's a critical question of, so if I identify someone that has an IRA or 401k, let's say I've got someone that's like, yeah, I got 300 grand in a 401k. Well, there's a couple of questions you need to ask to know, can that money go into my deal?
Okay.
And really the threshold question for a 401k, which is where there can be some problems. The threshold question for someone with a 401k is, do you still work there?
Mm-hmm.
Because if they still work there, most 401k plans lock them down. So if they're like 40 years old, and let's say they work at Dunder Mifflin, and they earn the Dunder Mifflin 401k plan, they can invest in only the Dunder Mifflin investment options, which are going to be ETFs and mutual funds, right? Only until they quit can they roll that money out to an IRA to self-direct and invest in real estate. So if it's a current employer 401k plan, those are a lot of times locked down. Now, if they've hit retirement plan age, 59 and a half or older, so let's say they're 62 and they still work at Dunder Mifflin, okay? It's like Creed or Meredith or something, if you watch the show. Like, even though they're still working at Dunder Mifflin, they can roll their money out of the Dunder Mifflin 401k to an IRA. Now that IRA can invest in your deal. Now, if someone has IRAs already, they're always going to be game. I don't care if they're at Fidelity or TD Ameritrade or Robinhood or their local bank or credit union. The IRA funds can always be moved to another custodian that will then let you self-direct. So That's kind of one area you got to know is the current employer 401k. When they're not yet 59 and a half, you can sometimes get stuck and not be able to tap it.
So that's the major flag or disqualifiers. If they're still the current employer that they have this account with, it's not eligible.
Yeah, that's the one that can just get a little sticky. Now, there's some caveats to that. Sometimes they can do what's called an in-service rollover. There's a little more you can peel back there sometimes, but just know that's the one where it can happen where you're not going to be able to get that money into your deal.
Okay.
But that's a minority piece of the money, actually. There's more money, like I've said earlier, there's more money in IRAs, actually, than 401ks in total. And IRAs are always fair game.
Okay. Even at their current employer.
Well, your IRA is an individual level. So you typically, at your employer, it's not an IRA. Now, there is a simple IRA that your employer could have, something called a simple IRA. But those you can move. Those, even if it's still at a current employer, you can self-direct that.
Okay. Okay. And then was there anything else you wanted to add to that in terms of, as a capital raiser, kind of going through your qualification questions?
Yeah. So once they're like, so the only other thing I'd add to that is once you're like, all right, they've got an IRA, they got an old employer 401k. Now you have 3 steps. First step is they need to open a self-directed account, like our company, Directed IRA. We're doing that, of course, every day. Second step is they got to fund it. Now you got to go get the money from Fidelity or Vanguard or TD Ameritrade or whatever. And the IRA company should do that for you. And so what we do is we go get the money. We can request it company to company and the money comes over here. So that's step 2, you got to fund it. Step 3 is that you have to invest it. And so the investor would then authorize us to invest in your deal, and they will fill out your subscription agreement, typically, but they're going to put it in the name of the IRA.
Mm-hmm.
So, so for Deana, for example, you're not putting your name, you're not putting Deana on the subscription agreement. You're putting Directed Trust Company, FBO, Deana's IRA. Okay. That's who's going to be the investor in the deal.
Mm-hmm. Mm-hmm.
So it's those 3 steps. IRA company should handle step 1 and 2 for you. And just remember in step 3, when they're authorizing the investment and filling out your subscription agreement, if they're going to use an IRA, the investor or subscriber, whatever it is in your docs, needs to be the IRA, not the individual person.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.